What's going on, everyone? You're back with your boy Jono for another quick math lesson. Today we're going to start a 3 or 4 lesson unit on interest, and this lesson's really just about the idea. What is it, and is it good for you or is it bad for you? There's not a huge amount of maths in this lesson, but we're just going to talk about what the concept is because it might help us solve some of the questions with more ease in the next couple of lessons. So when we're talking about interest in a financial setting, it's important to know what we actually mean. Where do we see this term? Sometimes you might see it in your bank statements. So your online banking account might pay you a little bit of interest every year. I got like $3 last year. How great's that? But why is this thing continually popping up on my bank statement? You might also hear it when people are talking about paying off a mortgage or paying off a car loan, which seems like way worse than having it in the bank. You might have also heard about interest when people talk about investing in companies or stocks and shares, and you could have even heard of it when people are talking about cryptocurrency. There's still interest involved in that. Finally, you might have heard things about the interest rates rising in Australia in the news. What does this actually mean, and why do people seem like they're pretty upset about it? So these are all different examples. Some of them seem good, some of them seem bad. So what is interest? Interest is the cost associated with using someone else's money. And this is the big takeaway from today's lesson. Interest is about getting a fee for lending your money to someone else. The first type we're going to talk about is when you earn interest, and this is the good type. This is where someone gives you money because you're giving your money to someone else. I know it doesn't really feel like it, but when you put your money into the bank, you are lending your money to the bank, right? You don't have it physically on you, the bank has it. So you're sending cash their way, and the bank's going to use this money to pay for things to grow their business. So the bank might take your money and then pay for extra ads, or they might pay for more stores or more employees. They could even then go invest that money themselves into different companies, right? Give a bank loan, and then they're earning money from your money. Putting out more ads, maybe more customers pay with them, so they're getting money from this. More stores, more customers, and even investing in other things could net the bank extra money. So because the bank is using your money to grow their business, they're going to give you a little bit of money back. So if we put in $3 in this example, you might get $4 back. So the interest that you're earning comes from you lending the bank your money. They do different things with it and make a profit in return. So it's a little bit more intuitive when we're talking about a company. And this is what investing is. You're giving your money to a company and they're going to take it and try to grow their business. So they might pay for more ads, more employees, more products, whatever. If they grow their business and make a profit, they're going to give you some of that money back. That is the interest that you're earning. So we've also got to talk about the bad kind of interest. This is the interest that you pay. So this is the reverse situation. The bank is going to give you money because you specifically want something. You might want to pay for a car or a house and you don't have all the money up front. So the bank is going to lend you some money. But the bank here is taking on a little bit of a risk, right? You might not pay back that money. Something could go wrong. You might pass away, something tragic could happen, but the bank is still out that cash. So what's really important to kind of think about is that the bank is taking on risk. So the interest that they're charging you is just there to kind of safeguard themselves for losing money. What's also important to understand is there is an opportunity cost that the bank has. By lending you the money, they can't put it somewhere else. So they might not be able to pay for more ads. They might not be able to open new stores because they've lent you a large portion of cash. So what that means is when you pay back the loan, you have to pay back the entire loan, the $4 in this example, but you're also going to have to give them a little bit of extra money for taking on that risk and for them letting you use the money and not giving it to someone else. This type of interest does accrue very, very quickly, and it can make what seem like pretty small payments massive if you don't pay that interest off really quickly. So for interest, there are only 3 factors that determine how much money you will either earn with the good kind or pay back with the loans. So the first thing is the principal, or the amount of money that's being used. We just call this principal P. So if you invest more money, you will probably make more money. You put more in there, so you get a little bit more back. This also means if you borrow more money, you're going to have to pay extra money back to the bank because they're taking on more risk. So the next thing is the rate, and this is a percentage of how much money you've either borrowed or invested, which is usually agreed upon beforehand. We just call this R, and it's a percentage. We will see it as a decimal point quite often, but all we've got to think about is that it is a fee for letting someone else use that money that is a percentage of the total amount. Finally, the time that the money is with someone else really matters as well. So if you've invested your money for a long period of time, you might make extra cash, but if you've borrowed money, the bank's going to want back more if you borrow it for 30 years compared to 3. This we call N, and it could be any type of time period. It could be months, weekly, yearly, doesn't matter. But what we're really talking about is how long is that money in someone else's hand. So in our maths class, we're going to learn about 2 types of interest. The first is called simple interest, and that's a really introductory level to understand this topic. It doesn't really happen in real life that often. The second type is called compound interest, and this is our real world example. This is how interest works in the real world. So just making sure that we're on top of what interest is and then being able to apply it to either making money or borrowing money is incredibly important. Interest is the thing that really determines whether or not you will be wealthy, right? People that make massive amounts of money, their salary is usually not massive, but they have a lot of investments that make money for them. So being on top of this concept is incredibly important moving forward. So I do hope you stick around to watch the next couple of lessons. Thanks so much for watching, and I'll see you later.